Return on equity is a key financial metric used to measure a company's profitability relative to the equity held by its shareholders. It indicates how effectively a company is using shareholders' funds to generate profits. This ratio is particularly valuable because it provides insight into the efficiency with which a company is utilizing its equity capital to produce earnings. Compared to other profitability ratios like return on assets, return on equity focuses specifically on the returns generated for shareholders, making it a crucial measure for assessing the financial health and performance of a company. Return on equity. Return on equity measures the percentage of profit a company earns from its shareholders' equity. To calculate this ratio, you divide the net income of the company by its average shareholders' equity. The net income figure is obtained from the company's income statement, and the average shareholders' equity is usually derived from the equity figures at the beginning and end of the period. Essentially, this ratio shows how much profit is generated for each dollar of equity invested. To determine return on equity, you first need the net income, which is the company's total revenue minus expenses, taxes, and costs, found on the income statement. Next, obtain the average shareholders' equity, which is calculated by adding the equity at the beginning of the period to the equity at the end of the period, and then dividing by 2. Finally, divide the net income by the average shareholders' equity to get the return on equity percentage. This tells you how much profit is generated for every dollar of equity. Example: consider a company that has a net income of $500,000 for the fiscal year. At the beginning of the year, the shareholders' equity was $2 million, and at the end of the year, it was $2.2 million. First, calculate the average shareholders' equity. Add $2 million and $2.2 million to get $4.2 million, then divide by 2 to get $2.1 million. Next, divide the net income of $500,000 by the average equity of $2.1 million. This results in a return on equity of approximately 23.8%. This means that for every dollar of equity, the company earned about 24 cents in profit. Low return on equity. A low return on equity might indicate that a company is not generating sufficient profit relative to its equity. This can be a sign of inefficiency in utilizing shareholders' funds, or it might suggest that the company is facing challenges in its operations or has a high level of debt. Companies with low ratios might struggle to attract investors, as the returns on their investments are less attractive compared to competitors. High return on equity. A high return on equity generally suggests that a company is effectively using shareholders' funds to generate significant profits. This is often seen as a positive indicator of financial performance, showing that the company is capable of generating high returns for its investors. However, if the ratio is unusually high, it might also signal that the company is taking on excessive debt, which could be risky if not managed properly. How can companies optimize return on equity? Enhance operational efficiency. Improving operational efficiency can increase net income without needing additional equity. This involves optimizing production processes, reducing costs, and improving sales strategies. Increase profit margins. Focus on increasing the profit margins by raising prices, reducing costs, or improving product offerings. Higher profit margins directly contribute to higher net income and thus a higher return on equity. Manage equity wisely. Companies can optimize return on equity by strategically managing their equity. This might involve repurchasing shares to reduce equity or reinvesting profits to sustain growth, both of which can improve the ratio. Key takeaways. Return on equity is a crucial metric for assessing a company's profitability relative to its equity. It provides insights into how well a company is using shareholders' funds to generate earnings. A high return on equity is generally favorable, indicating efficient use of equity capital and strong profitability. A low return on equity might suggest inefficiencies or financial difficulties, potentially making the company less attractive to investors. Companies can optimize this ratio by enhancing operational efficiency, increasing profit margins, and managing equity wisely. This ratio is a powerful tool for investors and management to gauge the effectiveness of equity utilization and overall financial performance.